Hey, just on Ansell, guys, it is a bit of a moving feast. Yesterday they reported, obviously this is the first report the company has released since its divestiture of its sexual wellness division. Remember, this was last May for $600 million to a Chinese consortium. They have reorganized the business as well into 2 global business units. That's coming down from 4. They've also instituted a company-wide optimization program they call Transformation. It's a good name of a program, isn't it? Transformation. The key focus here is to focus on the key value drivers of growth and profitability and costs out. Now, this program is targeted to put up $30 million in savings in the fiscal year 2020. That's not insignificant. That's about 5 to 10% of their EBIT currently. So that's a big uplift for them there. So it's really not surprising that the market really struggled to digest this result. It sent the stock up 3% and it closed down 4%. Down to 23.86. And now what's our view here? Well, actually, very little has changed as far as what we looked at in the results. There was no surprises at all in this result, believe it or not. The management team actually stated that the core business that is tracking to expectations because you got to wipe out all the fluff about the exogenous or discontinued ops. Of course, they put up really solid, good organic growth, 4.5%. That's at the top end of their 3 to 5% range that they're targeting over the medium term. This is really driven by growth in its core brands. That represents about 67% of the total sales of this business. That's up 5 points from last year. New products are kicking into their own as well. They're up 46% to nearly $100 million, so they're going strongly. But the problem is the margins contracted. This was expected. Raw material prices I flagged last week have been high. They're cycling a high coming out of last year. So that was well known, and the bottom line benefited from lower interest, lower tax, and share buybacks. Nothing we didn't realize or knew or didn't know. It led to the company upgrading the fiscal 18 by up to 5%. It was a soft upgrade, I would say, but you know what? We really expected them to do something on that front, as I said. So the results I would classify as a little mixed, albeit, as I said, as expected. So where to from here? Well, this is where the market really struggles, and even the analysts that cover this name, they're split. There's the buy camp, which includes myself. There's 3 of us. There's 5 in the middle at hold sitting on the fence, and there's 2 sells. But it really doesn't take a rocket scientist here to kind of stand back, take a deep breath, and look at what's driving this business. You have a cyclically exposed industrial name. It's the only one. It shouldn't be in the healthcare space. Obviously, I said this before. It's against a backdrop of synchronized global growth that seems to be going forward. This is good. Increasing product demand goes hand in hand with that growth. We have moderating raw material prices. Now, as I said, the first half was smashed because of those prices were high. They're cycling them. Those are gone now. Okay, so the second half will be much stronger. Forex headwinds are alleviating as well. They clean up the portfolio, obviously, with the restructuring, and they're looking to further optimize their product lines as well. So all in all, it looks like a net positive result. I'm happy to be there. Distribution partners as well, I'll point out, are driving up share gains, and they inked about 54 of those. They inked 54 distribution partnerships in the first half. That's more than they did completely last year. So those are going up really well. This balance sheet is clean as a whistle. More than $1 billion in headroom to do acquisitions. And they actually were saying that they have 1 or 2 in the pipelines, hope to get across the line in the next 8 to 9 months, although prices are being bid up, they did say. So really, for us, it's a no-brainer here. We're going to keep our ad on the name. We're going to raise our price target on earnings revisions. Believing a really restructured Ansell is much better than the Ansell of prior. And then it's a good option for a few years ago, how it looked like it was actually struggling. The future looks brighter for us, and the stock is trading. If you look at valuation, people talk about valuation, obviously important. It's trading about a market multiple on a forward basis, and I'm thinking putting up mid to high single-digit growth for an industrial name that's kind of in the face of the cyclical recovery, if you want to say that, or reinflation, or inflation, I should say. I think it's a good punt here. I think I like the name still on the ad rating there.